The expert who predicted the 2008 and early 1990s housing crashes warns again. In this video, I go through when a future housing crash is likely to happen, what exactly the 18-year property cycle is, and how this might compare in magnitude to the previous housing crises. So where did this 18-year property cycle theory come from? Well, Fred Harrison is a British author and economic commentator. After analysing hundreds of years worth of data, particularly from the US, UK, Australian and Japanese housing markets, he developed this concept of the 18-year property cycle. He first wrote about it in his book, The Power in the Land. In this book, he actually predicted that property prices would peak in 1989, followed by a recession. Then again in 2005, he wrote the book Boom Bust: House Prices, Banking and the Depression of 2010. And here he successfully forecast the 2007 peak in house prices and subsequent global economic collapse. So it's fair to say his track record here is very good. But what is the 18-year property cycle? How the theory works is it suggests housing market traveling through distinct phases, which are first of all the recovery phase, which can last 6 to 7 years, and that's generally modest growth in the housing market. Then you get a short mid-cycle dip. Before that, you actually get an explosive phase. This is also referred to as the final boom phase. Typically, it might last 6 or 7 years, and that's where you get the fastest growth. And then the final stage is the recession phase. That's where you get the downturn and likely housing crash. So why is it 18 years in particular? Where does that number come from? Well, Harrison actually doesn't have a definitive answer for this, but he suggested that this is the average length of time it takes a borrower to pay off the interest on a 5% loan. So there may be some correlation there. So where are we now? Let's have a look at the average prices. For this example, we'll use the UK to try and determine where we are in the cycle and when we might expect a significant housing crash. So in most countries, we've already seen that downturn happen, but will this accelerate? By the way, if you're enjoying the video, I'd really appreciate it if you hit the like button and subscribe if you're new to the channel. So according to the calculations, when you take into account the last housing crash back in 2009, you could assume right now that we're actually in the final boom phase and that we should expect a crash around the year 2026. So that's still a couple of years away. So you might be saying, well, prices have been going down the last year or two. What's going on there? Well, according to Harrison, this is just a small blip before the boom actually continues further over the next couple of years before we get that big crash. He believes that prices, they're just compensating following that premature hike in prices during COVID. He believes real estate and land will remain a hedge against inflation, so quite robust. He also suggests that with elections next year, especially in the UK and then in the US as well, money flow will increase as politicians overpromise and perhaps overreach. I'm going to share my thoughts in just a minute, but the final thing he also said was he believes this crash will actually eclipse 2008. So we could actually get a significant recession and maybe even a prolonged depression this time that could last a decade. So one thing I love to do when I'm looking at something like this is just analyze the figures, look back through the charts, look at the historical data and see what we can kind of figure out here. Now, if you look back to the peak prices we saw in 2007, the first thing I would say is just have a look at what was the drawdown in prices. That's the first thing to consider here, because when we're talking about a housing crash, how significant was the move down? From peak all the way down, we're looking at, I would say, about 18%. So not even 20% drop. Still very significant for people who have mortgages. They have limited equity in their property as well. And especially as interest rates are rising, even that as a dip is very significant. But where would that put us if we assume that the peak we saw in the UK anyway in June 22 was the actual peak? Where would we actually drop to? So the level here is 240,000 from a peak of 294,000. So that's a significant drop of 55,000. And that was the actual peak drop. That was the most that prices dropped in terms of the average house price anyway here in the UK from 2007 all the way up to 2009 before things bounce back and then stabilize for a period of a couple of years before then rising significantly again. What's interesting, when you move left with this line, what do you see here? That price will equate to the price we saw in June 2020. So around 3 months after COVID had actually hit. So actually, when you look at it that way, it doesn't seem as significant a drop. But I think the point Fred Harrison is making is perhaps the other consequences of a move like this in general period of higher interest rates. Now, what's to say we don't move right now? And these aren't just the early signs right now of a housing crash. So we're just going to keep moving down and we have this prolonged but perhaps slower crash. Actually, if you look here at the bottom, I've got a momentum oscillator here. This is the RSI. So this is going to be based off of these data points, these average house price data points. And you can see here the green area. This is basically when house prices you could consider were overbought for a period of time. And then the red areas underneath are very, very brief periods where the house prices, you might say the prices were oversold. So lower than perhaps you might expect. And you can see the momentum oscillator actually moves before the house prices move. And the middle line here, the 50 line, which I've just drawn on here, actually got hit in May 2008, where the house prices were starting to turn downwards and then accelerated. Well, notice we're actually already at the midpoint there and house prices have come down. So what this suggests is if RSI is a leading indicator, we don't know, this is just based on data and probabilities, but if this is correct, then we might expect from here over the next year or two for the house prices to continue to decelerate but at a faster pace. So this might already be happening, but a little bit earlier. So what does that mean then? His prediction was 2026. But it looks like if this continues, which I think could potentially happen, then what that means is by 2024, we might already have had our housing crash and we might be stabilizing from then onwards. Now, if that happens already, what does that mean? Well, the thing with these theories is that they might be right in terms of the different phases of the cycle. If you look at these phases, there's nothing wrong with this. I mean, this is, I would say, quite accurate in terms of looking at the data over the last 30 or 40 years. However, the time period we're in each phase can change. If we have a look at the average house prices in the United States, we can also check the drawdown and then compare. By the way, the increase in average house price from the lows we saw to peak is actually 130%, just for interest's sake. So let's have a look at the drop. So the drop in the US was higher. So it was just under 27%. So if we have a look at that now, so that was basically from peak price, average house price of around 330,000 US dollars and all the way down to 245,000 US dollars. Now, if we take it from peak price again and we do 27%, you can see there the peak price of 570,000 US dollars and then the drop to around 417,000 US dollars. So that's significant. That's 150,000 US dollar drop on average house prices. And again, if you look left, what you can see here is that actually, if we get down there, the price will equate to what the prices were only in March 2021. So well after the onset of COVID, approximately 24 months into it. So, I mean, what I would argue is if in March 2021, prices just stayed exactly the same and went sideways for 2 years, nobody would be batting an eyelid, and then they might start to grow again. Interestingly, this time on the momentum oscillator, you don't see any very strong negative pressure. Even from the last crash, it was more a gradual reduction when it came to momentum. And again, we just seem to be on that 50 line. The big issue that's worth noting that I'll discuss in a separate video, of course, is you have to take all the factors into consideration. So these are trends, average house prices, but the circumstances now are very different to what we saw in 2008 all the way up to 2011. You have to have a look at the actual listings available. You have to look at the supply of new homes available as well. So that's really interesting data, which I'll discuss very soon. Make sure you subscribe for that. So I think what's happened is the explosive phase here had accelerated because of COVID and because of the massive amounts of money printing, basically, and this excess money flow into the system, which obviously a lot of it ended up going into property and land. And so we had an artificially faster explosive phase. And everybody was obviously taken by surprise because people were saying, well, if everybody's losing their jobs, why is house prices going up? And then again, they quickly understood it was all to do with the very, very low interest rates or close to zero interest rates, incentives and schemes from the government. Now, what might happen going up to the election is things might just happen a little bit slower in terms of house pricing moving down, but then after the election, we may then see a massive increase in downwards pressure. What do you think? Let me know in the comment section below. We have more videos like this on the channel. Please click on one of the videos above for more analysis. Thanks for listening.